Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, Deputy Editor. And now we are about a week away from the budget, but we're also about 2 weeks away from the next Monetary Policy Committee meeting. And these are both obviously very important events because, the budget is, of course, key. It's the main economic policy document of the government, and the Monetary Policy Committee is meeting this time around. Everybody is hoping that they're going to cut rates, and there's an expectation that they will. So let's see what happens. But to discuss the need for cutting rates, whether it is needed in February or not, and what the budget should do, we have with you, as always, Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, let's first deal with the budget because that's the one that comes first. There's the big issue in government finances seems to be their revenue expenditure, which includes things like subsidies. And that revenue expenditure, do you feel that it is problematic and there's a need for them to kind of rationalize it?
Yes, certainly there is a need, because given first, let us talk about the backdrop in which the budget is being presented. Budget
Right.
is being presented in this, backdrop of slowing growth, and at the same time, the government would want to stick to its fiscal consolidation roadmap. So it has to do this tightrope walk between supporting growth as well as sticking to fiscal consolidation, not deviating too much from fiscal consolidation, and that would require some form of rationalization of revenue expenditure. And within revenue expenditure also, there are some items, there are some heads which certainly would require rationalization going forward, one of them being food subsidy. Because on food subsidy in the last 2 years we've seen a increase. On fertilizer subsidy we have seen an increase. Now, going by the findings of the consumer expenditure survey, which shows that the share of consumption expenditure on food is going down, and on cereals in particular is going down. There is a need to rethink whether we need to provide free food grain to 800 million population. So
Right.
that would help in rationalizing food subsidy expenditure, and that could be used for other areas of productive spending. So it's not that all revenue expenditure is needs to be rationalized. We need to spend on revenue expenditure on health, on education, and so on.
Of
But
course.
there are certain items where there is a need for rationalization, and that would free up fiscal space and help us move towards also, without losing sight of fiscal consolidation, help in supporting growth. So there is a need for a better revenue capital mix, and that would come through rationalization of revenue expenditure, in particular subsidies.
Right. So you mentioned that it'll give them space to do some other things. Are some of those other things is the likelihood of an income tax cut if they do manage to rationalize their revenue expenditure? Will that give them space for an income tax rate cut?
Yes, because again, if you look at the anatomy of India's growth slowdown, one of the
Mhm.
main reasons for the slowdown has been the weak urban consumption, and so on. We will have so long we will have weak urban consumption. It is highly unlikely that private investment will also pick up. So, if we want to ensure that consumption and investment pick up, from the budget side, what can be done is to announce some form of tax relief, which is in the form of income tax relief, and that would come only either through a revenue augmentation or through expenditure cuts. So if there is some form of savings on subsidies and some unspent amount on other things, that could leave fiscal space for tax cuts without deviating too much from the fiscal consolidation roadmap, which appears to be very much on the radar of the government, because we don't see government deviating too much from fiscal consolidation glide path, which is achieving 4.9% this year and 4.5% of GDP as fiscal deficit for next year. So within this overall macro stability objective, the government needs to do something to uplift the sentiments of the middle class through announcing tax cuts, But at the same time, it has to be very careful about its revenue shortfall. So, what kind of tax cuts could be done? What should be the nuances? That is very important, because what kind of tax relief should be provided should not be something that adversely impacts the tax base, because as it is, our tax base is very small. Only less than 7% of India's population is filing income tax, and even out of that, 60% is reporting zero income. So even
Right.
further, we should not be doing something which further narrows the tax base. So some form of changing in the tax slab is needed to help consumers boost their disposable income. And more importantly, even beyond the budget, there is need to think about cutting indirect tax, particularly fuel tax, because that will really help in two ways. One is it will help in taming inflation, because fuel inflation will go down, particularly when we've seen that global crude oil prices have been falling as compared to
Absolutely.
the peaks of 2022. So there is a scope for announcing some form of fuel tax cut. Of course, it is outside the remit of the budget, but all these things are needed to help, a broad-based improvement in consumption.
No, absolutely. I mean, I'm sure that most people and actually everybody would be very happy to see all of your suggestions actually come true. An income tax rate cut and fuel tax rate cut, and possibly even a GST cut by the GST Council. People would love to see all of this happening. But for all of that to happen, we need a better understanding of the revenue position of the government, both tax revenue and non-tax revenue. So, what is that looking like?
So for that, it's very important to look at what's happening in the first 8 months, the data that comes from the Controller General of Accounts. And it
Right.
tells us that, the revenue position is largely stable. It's not too good in terms of, whatever, if we look at what was projected in the budget and what is actually the growth rate that we are seeing in April to November, there seems to be some disconnect between that. So, for example, gross tax revenues growth is slightly lower than what was envisaged in the budget. Net tax
Okay.
revenues are growing much slower because of the increase in the uh, amount that is being devolved to the states and so on. More, the alarming part or the concerning aspect is the shortfall in corporate tax collection, because if we
Yes.
look at the April to November data, it shows that corporate tax collections have actually contracted by 0.5%. So that is something which is of concern. On the other side, income taxes have been doing quite well, and they have far exceeded the amount that was envisaged, the growth rate that was fixed in the budget. So, income tax collections have grown at 23.5%. So overall, there are some areas of shortfall. There are some areas which are doing much better. GST collections have been doing well, but every month we are seeing that growth is kind of tapering off. It's not picking up. The
Right.
growth rate is not rising. The absolute level GST collections, of course, they are rising, but the growth rate is tapering off. So all these, and then more importantly, this time around, non-tax revenue collections have cushioned the anticipated shortfall in non-debt capital receipts, which is disinvestment receipts, because
Right.
RBI has given a dividend of 2.1 lakh crore. But we don't know what is going to happen next time. It's very uncertain given that rupee is still falling, and what will be the RBI's response to the rupee slide. That will determine its income, and that will determine the amount of dividend it is able to pay to the central government. On the one side, because of the foreign exchange volatility, there could be some decline, the income would be impacted. On the other side, if RBI intervenes in the market and sells dollars, it will get some income. So overall, net impact is not very clear at this point in time. So non-tax revenue is not a given like it was last time. It's not a given that there will be very, that non-tax revenues would be able to cushion the shortfall that may arise in tax revenues. So overall, the position is largely stable, but it does not indicate a significant pickup that it is able
Right.
to, it's going to support tax cuts. So if the government thinks of giving tax cuts, it cannot be a very large fiscal stimulus without deviating from fiscal consolidation. And if it decides to go ahead with large fiscal stimulus to boost consumption, then it has to be at the expense of some savings on some of the other heads, like subsidy rationalization would have to be done, or savings on some other expenditure heads would have to be done. So these are the various policy trade-offs that the government would have to encounter. But overall, the revenue position, as I said, is stable, but it's not that it's great. It's not that great. And as it is, when we see the government's projections, they have kept it largely conservative. If you look at the
Yeah.
budgetary projections, and the other roadblock or the other deterrent here is that the nominal GDP growth has also slowed. So that is something which is not leading to increase in tax revenue collections. We saw that budget projection for nominal growth was 10.5. Advanced tax estimates peg nominal growth at 9.7. So with all these headwinds, we do not think that tax collections and overall revenue position would see a significant uptick in the next financial year.
Okay, so but the other thing is that capital expenditure this time around, this year, at least the data that we have, April to November, is showing that capital expenditure is something like 12% lower this
Yeah,
year than it
yeah,
was last year. And they look like they're going to miss their target for the year. So what
right.
does that say for the year ahead? I mean, should they be targeting better, or do they need to increase their capex? What is going on?
They need to target better. They need to set realistic targets, because we have seen a consistent sharp increase in capex allocation since COVID year, and that has helped in boosting growth. That has set in a virtuous cycle, trickle down impact on other sectors. But now is the time to rethink whether the strategy of fixing very ambitious targets of capex is something that the government would like to go ahead, because as you rightly said, capex is down 12%, and in two of the most important sectors, which is road and defense, capex is down by 16%, both for roads and defense.
Right.
So first, while setting the targets for next year, one needs to see whether this is due to implementation bottlenecks, or there are some execution problem, or there is problem with absorptive capacity, that we have reached the peak of absorptive capacity. Do we need so many roads, highways, or do we need to spend capex on health and education? So based on that, a proper review of sectoral allocation is something that would help in setting realistic targets, and something that can be achieved going forward also. So I don't think that the level of capex would be reduced, but the growth rate at which capex is set, I think that is something that will either be stable or will be slightly lower than what was fixed last year.
Right. So actually, in a recent interview that I did with Dr. Ram Singh, who's a member of the RBI's Monetary Policy Committee, he said that possibly he suggested that the government should focus some of its capex on cold chains and on warehousing,
Right.
because I mean, not only is that a productive use of capex, but it'll also go a long way in addressing issues of food inflation. Uh,
Absolutely.
so I guess that's something that the government should take note of as well. But
Absolutely. Also, on employment,
yes,
also, when the government has announced these schemes, the internship schemes, 10,000 crore on employment
Mhm.
linked scheme, they will also have a better impact if some amount of capital expenditure is is allocated towards skill development. So that will help in better employment opportunities, which will improve the employment prospects also. So when we talk about capex, the connotation has to become much more broader, and it should not be just restricted to the physical infrastructure.
and not just road and rail.
Yeah,
Yes.
yeah,
And okay, so now we've got a pretty good idea of the government's finances in terms of its revenue expenditure, capital expenditure, and the revenue position. So, what does this say about the fiscal deficit? They had targeted 4.9% for the year. One,
right.
are they going to meet this? And two, do you think that next year they are they going to shoot for 4.5, or do you think they'll give themselves a little leeway so they can increase capex?
I think this year they will achieve because there's a substantial savings going to happen as far as the capex is concerned. So almost 70,000 to 80,000 crore savings will happen. That will help them offset some of the possible revenue loss that may arise on account of corporation tax, and therefore overall fiscal deficit would be achieved this year. And I think for next year they will stick to 4.5% fiscal consolidation and not go ahead because that is, because after next year they are going to change their fiscal framework, as they have
Yes.
already announced that they are going to shift from fiscal deficit targeting to something where the fiscal deficit targets would be fixed in a way that the debt is reduced. So I think this is the last year of, the coming year is the last year of fiscal deficit targeting. So they would like to achieve that 4.5% fiscal deficit, and then also give some indication of what is going to be the new fiscal framework, which is anchored on debt. How is that going to look like? So that is something which would give impart some transparency into their thought process of how they are going to stabilize the debt to GDP ratio, which is going to rise because the nominal GDP growth is not expected to pick up substantially. So debt to
Right.
GDP ratio could see an increase, and therefore this shift towards debt is a welcome development. And more clarity on their thought process on how this entire framework would be implemented would be something would be welcomed by the investors, by the sovereign rating agencies, and so on.
And in your article, you also made a suggestion that in a bid to boost manufacturing, which is something that the government has been struggling with, you had suggested some changes to do with excise with customs duty. Sorry,
Right.
could you please elaborate on that?
Yeah, so in the last year's budget, the July 24 budget, 2024 budget, the FM had indicated that the government would look at a comprehensive review of the entire custom duty structure with an aim to boost manufacturing and to reduce trade disputes and all. And now at this current juncture, it is all the more important because the entire custom duty trajectory will be determined by this would be anchored by the persistent tariff threats. What is going to happen to tariffs, and therefore what kind of import duties we impose. So this entire relook at custom duty structure, the rates, the number of rates, all this becomes all the more important in the current scenario. And therefore there is a need to, I think, simplify the number of tax custom duty rates, which are almost 40 in number. So there is a need to reduce. That will help in reducing the classification disputes, will make the system more transparent, more simple, would reduce disputes. And on some items, there is a need to increase import duties to safeguard domestic industries. And also the entire reform of custom duty should be, should take into consideration fixing of the inverted duty structure, because still in some sectors there is inverted duty problem, so that needs to be fixed. That will help in boosting manufacturing at a time when China is slowing down and China is under threat of more tariffs, and there is this possibility of dumping from China to emerging markets. So in this challenging global environment, there is a pressing need for a complete relook at the entire custom duty structure from various considerations.
Okay, and all right. So that I think completes our look at the budget. Let's move to the RBI and the Monetary Policy Committee. First of all, I mean, I'll ask you bluntly: is it time, absolutely time, for them to cut rates now? Do you feel that February they really should cut interest rates?
I think they should now start thinking about cutting interest rates, and the tone should change now because we have seen growth coming lower than expected, lower than RBI's forecast, and also now that food inflation, which till now was very persistently high, it is showing signs of easing. And going forward, also the outlook for food grain production is favorable. Core inflation, which can be considered as a proxy for demand conditions, remains subdued in the range of 3 to 4%. So I think all tick boxes can be checked for thinking about, not in February, but at least in April, now they should start thinking about cutting rates and also changing the stance towards accommodative, because unless rates are cut, and rate cuts and liquidity, both things have to be managed simultaneously. If rates
Right.
are cut but liquidity remains in acute deficit, then rate cuts transmission would not happen. So it is the time to start thinking about providing a comfortable liquidity situation, as well as start easing monetary policy and not be swayed by exchange rate considerations, for which we have other instruments. RBI can always intervene when there are violent swings, but monetary policy should not be unnecessarily kept tight to support the rupee.
Absolutely, and this is in fact something that over the last few days I've had a few interviews with various economists, and they all agree that it's about time that the RBI kind of goes easy on its exchange rate controls. So now I have a few questions from the audience, and Aditya asks. He says, "Do you think if the budget comes up with some much-needed tax relief, the RBI might be tempted to reduce interest rates in order to further boost household consumption? Are both tax cuts and interest rate cuts required to boost urban consumption, or can either one of them be enough?"
So I think the transmission channel for both are different. The implication, the impact, the timing that it takes to boost urban consumption through any of this impact, through any of this effect is different. So I think both should be considered. The budget should certainly take a note of the slowing urban consumption and the need to introduce tax relief so that there is some relief for the middle class. So tax cuts certainly, and also going forward, interest rate cuts. Though interest rate cuts, we know that monetary policy works with a lag. So if the interest rate cuts are announced in February, it's not that the next day we will see a boost in consumption, because monetary policy takes some time to have
Right.
an impact. How much of that will be transmitted to the banks' lending rates and deposit rates and so on. The transmission channel is very important. So, but tax cuts would definitely help in boosting consumption. Monetary policy actions take some time to show their impact. Just like the tightening takes time to show impact, monetary policy easing also takes time to show impact. So it is the time is right for both the policies to ease a bit to boost consumption.
Okay, and Sankalp asks, is the budget overrated? Beyond reshuffling of revenue sources, nothing much has happened over the past few years. What has been the progress on the promised monetization of key assets? Why is the government so slow in executing these projects? The much weaker Vajpayee government, he says, was able to get more disinvestment done.
I think that's correct, because we've seen actually a visible shift in the government's thought process, thinking on the disinvestment policy. In
Right.
2021, the finance minister did announce a strategic disinvestment policy that, leaving aside a few strategic sectors, the government would step out of the various sectors and there would be privatization. But now we see, with the recent instances of equity infusion, we've seen 2 days back there was a financial package announced for RINL, Rashtriya Ispat
Yes.
Nigam Limited. So it all shows that there has been a shift in the government's policy. All this signals a shift in the government's policy, that it is no longer very enthusiastic about disinvestment, and that is also visible in their the budgetary performance. Each time they are reducing the target of disinvestment, but they are not even able to achieve that target. And going forward, I think they're going to reduce that budgetary target further. So it shows that they are not that enthusiastic any further about disinvestment. But on the other side, they should at least go ahead with monetization. If they have to raise
Yeah.
revenues, alternate sources of revenue, they need to expedite the monetization of some of the infrastructure, airport monetization, and all these things can really help. They are low hanging fruits. They can help in augmenting their sources of revenues. So there is a scope to do much better on the monetization front.
Right. And just to address the first question, that which is the budget overrated? Now, I mean, I feel that I don't think that the budget is overrated, but certainly with a lot of indirect taxes being subsumed under GST and all of those decisions going to the GST Council, uh, quite a bit of the tax part of the budget is now outside the budget, as it were. It's with the GST Council. So in that sense, the significance has gone down, but the budget is still the key economic policy document of the government, and in that sense, it is still significant. But on that note, that's all from us. The to recap, basically, what the government needs to do is to provide some sort of demand stimulus, hopefully income tax cuts. But if we are to see all of that, we are also going to need them to rationalize their revenue expenditure, because food subsidy has been rising, fertilizer subsidy has been rising, and unless they cut back on that, they aren't going to be able to afford to cut taxes by very much, because they're also going to go ahead with their fiscal consolidation plan. And as we have discussed, capital expenditure is already lower than expected to do. So to say that they should cut that even further is not going to work, and we need capex for growth. So the only thing that can be cut is revenue expenditure and subsidies, but that, of course, is a political decision. But something needs to be done. And for the RBI and the Monetary Policy Committee, they need to stop focusing so much on the currency exchange rate. They need to now seriously consider cutting the interest rates, because there is a lag. When they were raising rates, the hikes came, they hit the economy with a lag. Same way, when they start cutting rates, that effect is going to come with a lag. So they should start soon, because growth is suffering, and inflation, at least the key parts of inflation, seem to be under control. But on that note, that's all from us. Thank you so much for watching.